Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Mathew. Now, there is one investment that if you had made over the course of the last 10 years on a compounded basis would have done better than an investment in the Nifty 50, and that means that it would have done better than quite a few other investments. And some of you will already know what I'm talking about because you've invested in it, whether you like it or not. You've bought gold. And if you look at the compounded annual growth rate of gold over the last 10 years, then when it compares to the total return index of the Nifty 50, gold has returned about 13.9% and the Nifty 50 is at 13.15%. We'll talk about why gold has been such a spectacular asset class and what you should do at this stage, because over the last few months, despite geopolitical tension in various parts of the world, gold prices have not moved up very substantially. We'll also talk about your strategy when it comes to silver, because a lot of people have been talking about silver versus gold. Usually there is a ratio that describes the value of gold versus value of silver, and it is actually the gap between the two is widened quite considerably. Will that gap be closed, and does that provide an opportunity for you? We'll talk about that as well. Joining me today is CA Abhishek Mehta, who is the founder of Invests Capital. Thanks so much, Abhishek, for taking the time. Let's talk about the performance of gold. Of course, you've probably been studying it for some time. Why is it outperformed?
So in the last 10 years, if you see, there are three major reasons why gold has outperformed the Nifty 50. One of the first major reason is there is a heavy buying from the central banks. If you see, China has added almost about more than 500 tons gold in the last decade, and even Russia has added more than 900 tons in their reserves of gold. 1/5 of the gold reserves today are held by the central banks. And Russia has been one of the key players in adding gold reserves in their kitty. The reason is that China today, if you see China's numbers, China today ranks second in terms of GDP. It is second in terms of military forces. It is second in terms of foreign reserves. It is second in terms of market capitalization. But still, in terms of gold reserves, it is almost at the rank of sixth rank now. So my estimate is that even though the last decade has been very good for gold, another one decade, like in the next 10 years, Russia and China together will be adding a lot of gold in their gold reserves because they would like to de-dollarize the foreign exchanges and get their currency stronger as compared to dollar. So that is one of the key reasons why gold has performed. The second reason has been, obviously in the last 3 years, we have seen a pretty good bull run in the gold market. The geopolitical tensions, whenever geopolitical tensions arise, obviously gold is known as a heaven and everybody moves to gold, whether it is US-China trade war, whether it's Russia-Ukraine, whether it's India-Pakistan, all the wars have led to the increase in gold prices. Third reason is always gold is a very good hedge against inflation. So whenever, like we also do asset allocation, we tell clients ki invest some amount of bit of your money into gold because it is one of the best asset classes to hedge yourself against the gold.
Okay. So those are three reasons why gold has outperformed. Now, I do want to ask about the best way to buy it though, because Abhishek, and I know this conversation has happened so many times, even I have had this conversation several times, but it bears repeating. A lot of people think that investing in gold is going out and buying gold jewelry. Now, there are so many digital options available. Unfortunately, the sovereign gold bond is no longer available. So with that knowledge, what is the best way to invest in gold? Would it be through the gold ETF?
So before we jump into how to invest, I would also like to, talk about the risk before. Because I personally believe that once we go into an asset class, first let's talk about the risk. If you see the standard deviation of gold over the last 10 years, it is about 18.25%, whereas silver is 23.75%, which means silver has a higher volatility rate. So whenever you are choosing between the two asset classes, whether it's gold and silver, be aware that you will face more volatility in terms of silver. So silver should always be bought in a staggered manner. Now, how can one invest into gold and silver? There are two major methods. One is ETF and second is fund of fund. ETFs is a very good method. You can probably purchase 100, 200 rupees also, 500 bucks also. Lot of time investors confuse that their actual physical gold returns and the online gold returns will be same, but that will not be the case because of three major reasons. One, when you go and purchase from a retail shop, you have to pay GST. Second, you have to pay making charges. Third, your retail gold prices are always higher as compared to wholesale rate prices. So I would like to urge all investors, if you are going and purchasing gold as an investment asset class, always go for ETFs or fund of fund, and especially for silver, go in a very staggered manner because silver has a very high volatility rate as compared to gold.
I want you to describe this. Now, a lot of students of mathematics or even economics will understand what you say when you say standard deviation. But
Yes.
from the perspective of price movement over the course of 10 years,
Yes.
what this would mean is that there could be a deviation at any given point of time up or down by as much as 18% from the long period average. Is this correct?
Right, right. So I always, in a simple manner, it is the turbulence which you face. So when you catch a flight, the amount of turbulence you will face from going to your destination A to B. So gold will give you a turbulence of about 18.25%. Consider it as a pendulum. So it can go 18.25% down, it can go 18.25% up. And silver will give you a turbulence of 23.75% when you are going from one destination to another.
So we've established what that is, and in the meanwhile, the Nifty 50 total return index had a standard deviation of 12.6%, which is at any given point of time, it will still give you a positive return even in a lean period, whereas a gold investment at some point of time you could turn negative over the course of that 10-year period. Basically, this is what it means. But you've also told me about the efficiency ratio. What do you mean by that?
Efficiency ratio basically means for every 1 unit of risk you are taking, what is the return you are generating. So it is basically return divided by the standard deviation. It just gives you that whether my risk was perfectly correlated with the return or not. So Nifty 50, if you will see, the efficiency ratio turns up to 1.04%. For Nifty 500 index, it turns up to 0.92. For gold, it is 0.76, and for silver, it is 0.48. So silver has the least efficiency ratio because of the higher volatility rate. And also silver in the recent year has not underperformed, but to its peer, it has not performed that good as compared to gold. But I personally feel that in coming next 10 years, silver might be a very good asset class because it has gone away from the precious metal. Nowadays, silver is being used in a lot of things like EVs, solar, your medical devices. So I personally feel that in the next decade, silver would be an asset class which will outperform gold in a period of next 10 years.
Okay, so and that's an important point that you make, because we're looking at all of this in the rearview mirror, Abhishek, and
Yes.
we've seen a tremendous rally for gold. As things stand right now, like I said, that gold-silver ratio is at the widest that it has been in a long time, and so from that perspective, what you're saying makes sense. We could see a rally in silver prices, and so if we have a conversation 1 year from now, maybe the figures that we've just spoken about will be different. But having said that, what you just referred to, I was reading that that 2/3 of demand for silver actually comes from industrial sources. So exactly what you're saying. And so when demand goes through for industrial sources of silver and supply constraints are resolved to a certain extent, you can actually see a rise in silver prices as well. But having said that, how should an investor invest in silver? To what extent should they invest in silver and gold?
I think you can invest almost about 10 to 15% of your wealth into commodities like gold and silver. Like I said, one of the best ways to do it, not through the physical channel, but through ETF and fund of fund. What's the difference between ETF and fund of fund is more or less on the taxation part. ETFs are more better as compared to fund of fund because ETFs will give you a 12.5% taxation after a year, and fund of fund will give you a 12.5% taxation after 24 months. So the best way to invest into gold or silver, I think probably you can buy silver Bs and gold Bs through the ETF channel, and it will give you a taxation of only 12.5% after a year. Also, physical holding, has a lot of hassles, Alex, because every time you want to go and sell, you have to go out to your house, you have to find the rates, then sell it out, and the liquidity becomes an issue. Whereas the liquidity is much better in terms of ETFs. You can just go on your app or call your broker and sell those ETFs very easily. I would also like to point out one thing is gold and silver has a negative correlation with Nifty 50. What does negative correlation means? Whenever Nifty is negative, gold outperforms Nifty. So if you see the past data, let's look at some data. In 2003, Nifty was down by 11.7%, but gold was up by 8.4%. In 2009, Nifty was down by 35% and gold was up by 26.80%. What does this means is that you should not put all your eggs in one basket. The negative correlation in an asset class is very good because when one asset doesn't perform, the second asset class will perform. So that will reduce your volatility in the portfolio level and give you a better returns.
Okay, quick question on this and then we move into asset allocation. When you're buying an ETF, what is the efficiency of the ETF? And by that I mean in terms of pricing. For example, if I go to Zaveri Bazaar and if I were to look at the value of gold, they will give me the market rate. But on an ETF, there is sometimes a dislocation and it's not exactly that same price. How likely am I to get the market value as close to market value when I'm buying gold on an ETF?
So in fact, the efficiency is much better when you are buying, because when you go to a wholesaler or retailer, he obviously keeps his spread. Whenever he's buying, he's selling probably $1,000, lower, and whenever he's selling, he's charging you $1,000 more. So more or less, you would get a 99.99% efficiency when you are buying an ETF as compared to physically going and getting the gold.
Okay, got it. Let's talk about asset allocation, because you said 10 to 15% in gold and silver.
Yes.
But what happens with the rest? Because a lot of people have this tendency, Abhishek, to run after things that are doing well. So if, for example, gold is suddenly running up, then they'll say, why not put more money in gold? And the entire asset allocation goes for a toss. Is there I know there are lots of thumb rules to follow, but incidentally, when we were talking about, you said that asset allocation goes back to the 4th century BC.
Right. So I was just reading about asset allocation recently, and I came across thousands of years back, Jewish came with a literature called as Talmud. So what does that means is they said that divide your money into 3 asset classes. One is physical, where you buy gold, real estate. Second is you buy businesses. So probably you invest into equity, you invest into mutual funds. Third is you buy debt products or products which are liquidable. So they wrote thousands of years back and they back tested it at that time. So what they came out with this result was that if you follow this method of one third into physical, one third into commodity, one third into your liquidable assets, then 9 out of 10 years, you will be in the top 25% returns. The only important thing is you have to rebalance your portfolio every single year in a disciplined manner. That means you have to sell whatever has gone up. You have to sell your winners and buy your losers. If you keep doing that, in 9 out of 10 cases, you will be in the top 25% asset allocation. Now, this Talmud portfolio was also taken ahead by Markowitz, who won the Nobel Prize in 1990. The same portfolio was also referred by Roger Gibson in his 1998 book called as Asset Allocation. Asset allocation has 5 key takeaways. I would like to discuss that because people always they listen about asset allocation and they keep it on the back seat while investing, because people get more interested in investing in asset classes which have performed better in the near future. There are 5 key takeaways for the asset allocation thing. The first thing which came after the Markowitz theory is your return and risk both are calculatable. What does that means? Return is very easy to calculate. You put 100 rupees, you get 200 rupees, you say, I got 100 rupees return. But you need to calculate your risk as well. How do you calculate your risk? Like we said earlier, through your standard deviation. The second key takeaway of your asset allocation is that more risk always doesn't means higher return. After a certain point of efficient frontier, even if you keep taking higher risk, your returns will not increase in the similar linear fashion. The third key takeaway is adding asset class into your portfolio will reduce the risk but not reduce your return. So always have about 3 to 4 asset classes in your portfolio. Fourth thing is rebalancing is very important. Rebalancing is it's like in your employment, every month you get salary, and at the end of the year you get a bonus. So if you do rebalancing, rebalancing will give you a rebalancing bonus after a longer period of time. Also, rebalancing helps you to stay disciplined. In bookish knowledge, we always hear that you should buy, low and sell high, but we are not able to do that because we don't have a perfect asset allocation in place. So asset allocation really helps you to stay disciplined when you are investing in your journey.
Okay, so some key takeaways of asset allocation, and those points are well made, particularly the one when it comes to averaging both on the upside and on the downside. It's not the easiest thing to time the market, and not many people can. So follow a simple asset allocation strategy, as Abhishek is suggesting. Let's talk about a scheme or category of mutual fund schemes that is doing exactly this without you having to churn too much. And this is multi-asset. We speak about it incidentally, Abhishek, whenever we speak about gold, but I don't think that that should be the case. And I know that mutual funds have different interpretations to how they do this multi-asset strategy. So let me ask you this. If we were to look at the key functionality of these schemes, to say return maximization would be one, the second would be absolute balancing of asset classes and shifting between asset classes, and the third being capital protection. How would you describe these three principles and talk about schemes in the same category?
Right. So one very good category which mutual fund has evolved it into is called a multi-asset allocation fund. How did this evolve? Earlier, there was 100% equity where 100% of the money was getting invested into equity. Second, what came is a balanced fund. What was balanced fund doing? 75% equity, 25% debt. The fund got evolved more, the category got evolved. They came up with a balanced advantage strategy. What it used to do is it used to play between debt and equity, and say whenever the equity is on a higher side, they would go up to 30%, 40% on the equity level. Now, after that, this category has evolved further and they have come up with a category called as multi-asset allocation. What does multi-asset allocation means? You have to have minimum 3 asset classes in your portfolio with a minimum 10% asset allocation to all these 3 asset classes. We will discuss 3 mutual funds of this category. One is DSP mutual fund, second is White Oak mutual fund, and third is ICICI. ICICI is one of the leaders in this segment. They are managing 52,000 crores in today's multi-asset allocation fund. The fund is managed personally by Naren and 2 other fund managers. What does this fund try to do is they try to have a 65%, more or less 65% equity exposure. Second is they try to have some exposure on the debt side. Third is they have an exposure on commodity side. So if you see the asset allocation today, they have an equity portion of 52%, debt portion of 35%, commodity is about 12%. So they have divided into the 3 asset classes. The entire agenda of the fund is more or less to have lower risk as compared to Nifty and deliver better returns as compared to Nifty 50 by doing the asset allocations. Now, what is the difference in this fund and the other 2 funds is that of the taxation. they try to mirror an equity taxation, which means they at any point of time have to keep 65% of their funds into equity, and then probably they try to hedge it with the options. But the first agenda, because they cannot go below 65% to get an equity taxation, they have to always try and chase the equity side more as compared to chasing the other asset classes. DSP and White Oak comparatively are really going by the T of being a multi-asset allocation fund. What they have done is, first, in terms of taxation, they don't follow an equity taxation strategy. They follow a taxation strategy which states if you have more than 35% allocation in equity, you can put your money for 2 years and have a 12.5% taxation. So first, they are stress-free in terms of keeping 65% allocation in equity. Now, how does White Oak does is, White Oak has 31% in equity, 56% currently they are having in debt. They are having about 4% in commodity, and they have put in real estate and REITs and invest as 7.5%. So they are particularly trying not to beat the market, but to be a pure asset allocation play where having three asset classes. One is equity, second is debt, and third is real estate in their portfolio. At the same time, DSP is doing something different. What DSP is trying to do is, because they are master in picking foreign equity, they have an Indian equity exposure of about 37%, foreign equity exposure of about 21%, debt is 25%, and gold and silver is about 15% in their portfolio. They have one of the wonderful names in the foreign equity side. They have GE, they have Amazon, they have Nike. They're one of the funds which is DSP Value Fund. Still holds Berkshire Hathaway as a share. So because they are, very good in picking foreign stocks, they have a foreign flavor in it. White Oak is good in, picking, Prashant Khemka is good in picking the real estate side. So they have a flavor of real estate in them. ICICI multi-asset allocation at the same time is having more towards the equity side, because Naren is a pure equity player in its investment strategy.
Yeah.
If you look at the standard deviation of all three products is very different. ICICI multi-asset allocation fund has a standard deviation of about 12%, which means almost like an equity fund. Nifty has a standard deviation of about 13-14%, and they are having a standard deviation of 12%. White Oak has a standard deviation of only 4%. Its 1 year return of White Oak is 15%, yet it has a standard deviation of only 4%. So White Oak is really, living by the T.
Okay, so you've actually elucidated that point. You want to very quickly tell me what the standard deviation for DSP's multi-asset fund is?
8.54%.
Okay, so that kind of bears it out, right? Because the objective of each of these schemes is slightly different. So when you're investing in this category as well, which a lot of people tend to do because they say these will give me gold allocation, it's not always necessarily true. It could actually be true, but it's not always necessarily true. And I hope that we've given you some perspective, viewer, on how to look at these schemes and this category. Abhishek, thanks so much for joining me today. Absolute pleasure having you on the program.
Thank you so much.
All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for watching, and do stay tuned. This is NDTV Profit.